Thank you very much for that kind introduction. And thank you, Uncle Raymond, really, for the energizing dance. Really, dancing is for everybody, and so is financial planning. I want to ask Colin Lai to stand up. Colin is the star of our little video there. Really, everyone, please help me to thank Dawn and Colin and Uncle Raymond. So good afternoon, ladies and gentlemen, and thank you for spending this precious Saturday with us here at SOTA. Now, before I begin my presentation, I would like to acknowledge our sponsor, Dimensional Fund Advisors. Now, Dimensional and MoneyOwl, we have a long-standing partnership that dates back to the time when we started our investing services at MoneyOwl. While Dimensional is this big US giant and MoneyOwl is a small Singapore social enterprise, we come together because we share many things in common. The way we think about markets, the way we think about investments, and also the values that we hold very dear to us. I think Dimensional won't mind me saying this, but I think our companies, we are the kind of quieter sort and not very good at the sleek type of marketing, and Dimensional, you have so many big brains behind you, Nobel Prize winners, but you don't brag about pedigree. In fact, you don't even advertise. That's why people don't know about the gem of this fund manager called Dimensional. We both trust markets more than individuals, no matter how brilliant. And we are very careful to call a spade a spade. If we have a set of solutions that is very fancy, lots of bells and whistles, but we have a simpler set that might be a bit boring, but which works for you, we'll tell you, please go there, because sometimes when we do less, you actually gain more. So MoneyOwl, well, our mission really is to help every person in Singapore, the ordinary person, live their best possible life. And in life, there are things that you can control, but there are also forces that you cannot control. Well, disclaimer, I cannot control. Okay? Compliance say you must put there, so please read it. But back to Colin, right? So Colin is actually a top financial planner awarded by the Financial Planning Association of Singapore. And this is something that he achieved because he decided that he wanted to be a good professional that has the client's interest best at heart. This was under his control. However, Colin also happens to be a very wicked boss who wanted to tekan him and put him on this escalator whose direction he cannot control. And it pulls him down even as he tries to get to a higher level. And the more he struggled, the worse it got for him in terms of the risk to himself. And that is also inflation, what inflation does to us. Inflation is a kind of risk that we have no control over. We are not immune to its effects, much as we don't like it. And you look at this set of numbers here. In investing, we always talk about compounding. Do you like this set of numbers here? You would if this was the value of your portfolio going up over time according to compounded return. However, if this was your expenses sheet, compounding at inflation, then you might not like it so much. When this is an investment seminar, and when investors talk about risk, they tend to think about, when there's inflation, what does it do to my assets? What does it do to my stocks and all that? But I learned from Professor Ken French, one of those big brains behind Dimensional, that risk is not volatility. Risk is not standard deviation. It's not even some, esoteric downside deviation measure. Risk is actually, for us as individuals and families, the uncertainty of your lifetime consumption. And inflation poses this kind of risk to us across the whole timeline of our lives in 3 dimensions. Firstly, today, and then from today until our retirement time, which is our accumulation period, and finally, in our retirement years. So let me go through each of these phases, how inflation impacts us and how we can manage it. Inflation threatens our best possible life today because it increases our expenses. I'm sure some of you took lunch before you came here. I hope you did. Or maybe you took a Grab or a taxi. And those prices, wow, I think you would agree that perhaps we are indeed deserving of that most expensive city in the world position a few years running. But inflation also increases our expenses, or affects our lives today with a second-order effects. When policymakers started to tighten monetary policy and increase interest rates, it increased the debt payment that we have to make, and also it caused uncertainty in the markets, leading to the job uncertainty, and I think we've all read about job layoffs as well. On the debt payments, if you had a $700,000 mortgage, say 3 years ago, and you had a 1.5% mortgage rate, and you have to refinance now in year 4, and the rates have gone up to 4.5% or so. These are not very far from the actual rates that are being offered in the market now. You would actually have to pay in a year $13,500 more, or every month $1,130 more. So this will be an immediate impact on you. So by the way, this is just our own calculator, and for those of you who are interested in getting a copy of it, do scan the QR code and we'll send it to you. It's just for our audience today, because you might not want to talk to your banker yet, right? So you can do this on your own. Just scan the QR code there. So $1,130 more of expenses a month. What are you going to do about that? Or what can you do about it? You can go to your boss and say, produce the MoneyOwl calculator, right? And say, please, I am going to have to pay $1,130 more. Can you please give me a pay rise of $1,130 more? Okay, you can try, but I'm not sure how successful you can be. In the short run, it is actually very, very difficult to increase your income. Of course, you can, but it is not easy. And I would like to have a word of caution here. Please do not look to the markets to give you that extra income immediately, because it is actually very dangerous. It is speculation, and many people have lost their pants because of it. What is probably more under your control is actually to manage other expenses. In terms of insurance payments, a lot of us are probably overpaying for insurance. We are not overinsured, we are just overpaying for insurance. You might want to restructure that together with a trusted advisor. And there is also the tightening of belts that I think Dawn will give us some tips on. And finally, no matter what is the situation on the markets or inflation, do set aside an emergency fund. Why do we say that so much in investing seminar? Well, if you look back at the timeline, you see that a lot of us are accumulating. But when we accumulate, we assume that besides our current assets, we have a surplus every month, that the income pays for our expenses, and we can invest the surplus towards a bigger future asset that will fund our retirement or financial independence. However, once the income stops, where are you going to fund your expenses from? If you have to fund it out of current assets, you're actually jeopardizing your financial plan. And the worst thing is to have to sell down your investments in a down period when it's actually possibly a very good time to buy on sale. So this is the reason why we say, please build an emergency fund. So don't think about it as, cash wasted, because that cash, might just be earning you 3-4% or so. But if that 3-4% on the cash allows you to keep being invested to earn that long-term 8% or what, then actually what is that real return on the cash if you think about it? Right? So financial health is very important. And we say that get yourself in order, because investing and accumulation journey is a marathon. So it's like running a physical marathon. You need to be financially fit and healthy. So it's like my kind of pattern cannot, okay? You must go and get yourself in good financial health in order to get there. And that's why we say, do this check, and you can do it through MoneyOwl's comprehensive financial service. Besides the emergency fund, we ask you to look at things like your total debt servicing ratio. The banks will lend you money based on 60% total debt servicing ratio. But as financial planners, we advise you, please try to keep it to 35% or below. If you think about it, if you kept to 35% below, you would be able to stomach an increase in mortgage rates like the one that we have, or at least it will not be so stressful. So get yourself into good financial health, and that is the implication of what you should do because of inflation affecting all these things and your expenses today. Next, let's talk about this big accumulation journey that we are very interested in, about investing and all that. There's a lot of brain juice that goes into thinking, what is the inflation-friendly stock? What is the thing that benefits from rising prices? Which sector, which country, which stock, or which asset class? But, sometimes the simple things, the solutions are right before us. And if you look into history, the good news is that simply staying invested in capital markets instruments, mainly stocks and bonds, actually beats inflation over the long run. And here you can see a long-term chart. Now you might tell me, well, okay, Chuin Ting, this is fine, but I don't have 100 years, What about in high inflation years? Actually, in years where in the US, you see that where inflation has been above median, most asset classes actually also outpace inflation. And this includes the small caps, stocks, value stocks that are tilted, that our dimensional portfolios are tilted towards. T-bills are probably the only ones where it's not clear that it will outpace inflation. And there's a lot of fuss nowadays about, this cash, T-bills and all that. But I like to say that it's good to optimize your cash. And we also have our own Wise Saver solution that's offering about 3.5 or 3.6% yield, but it's not going to help you beat inflation over the long run. Right? So please take a look and see that if you're really concerned about inflation, what you should be doing, and we should all be concerned about inflation in the long run to keep our purchasing power, is to consider capital market instruments. And why is this so? Why does it work? Why do stocks and bonds work? I think you need to understand what stocks and bonds are. When you buy a stock, you are actually giving capital, or indirectly or directly, to a company to conduct operations, to meet the demands through goods and services. It's a real productive return. For bonds, you're lending the company money. So what happens is that in the world, what drives stock prices? Ultimately, it is the earnings of companies. The best companies in the world, in aggregate, go up over time because demand goes up over time. And what in aggregate drives demand, globally speaking, is things like population growth and the human quest for a better standard of living. So stocks and bonds ultimately are about the market economy, and they are about human enterprise, and they are about productive return. When you buy a stock or buy a unit of a fund that has thousands of stocks, you're actually investing in thousands of companies' growth over the long term. Some people are scared of this situation where you have both inflation and negative growth, and we call that stagflation. Even in this very hard landing scenario, you find that in the US, there had been 12 stagflation periods in the past. And if you can see where there are green dots in that bottom right quadrant for you, you'll see that actually out of the 12, in 9 years, equities have returned a positive return. Even bonds, 5 out of 12 have been positive. So we talk about stocks and bonds being where you can go to outpace inflation over the long term. And the question that I always get is, now that it's inflationary, what asset allocation, what type of mix should I get between stocks and bonds? Should I be all out of bonds? Should I be all into equities? Should I go into cash, etc.? I'd like to put it to you that your asset allocation is not dependent on the macro environment. So once again, your asset allocation should not be dependent on what is happening in terms of the economy. Instead, it should be based on these 3 factors. First is your required return, or your need to take risk. The second is your time horizon, or your ability to take risk. And why is this so? If I only need this money 30 years from now, then the likelihood that I can ride through the ups and downs and not having to liquidate my portfolio for that need during a down market would be very low. Whereas if I had to have that money 1 year from now, there's no telling where that short-term volatility would bring markets. The ability to take risk is very, very important. So for this money you are putting away, what is the goal? What is the time horizon? And third is what you can tahan. You can tahan. What can you take in terms of willingness? Now this is very, very important because the stock market is like a roller coaster. And in particular, a 100% equities portfolio is like the Battlestar Galactica in Sentosa Universal Studios. Level 5. Mummy is level 4. Okay? And like before, you have to put financial health, right? So if you have a heart condition, you cannot go on these things, right? For example. So you're in good financial health and you go on this roller coaster. But the stock market, unlike the real roller coaster, only straps you in lightly and provides you with a stop button you can press to stop. So what happens when you are round and round, you're scared, and you press this stop button? You will fall to your death. And this is what happens to so many investors over the ages. They can stay invested. They don't, because they panic. They press the stop button. They turn that temporary decline into a permanent loss and jeopardize their goals. So once again, inflation or anything that happens in the markets or in the economy does not change your asset allocation. If you have a good advisor, robo, human, bionic, whatever, all this work should have been done beforehand, and then you stay put through the ride. What inflation does is that it increases the buffers that you need. It means you have to save more. It means you have to invest more. Or you need to tighten your belt so you can invest the same amount of money. It does not warrant you changing your asset allocation, going in and out of markets, in and out of bonds and stocks. The only time when you do change your asset allocation, inflationary or not, is when your goals change. So for example, you were going to retire 15 years from now. But you tell me that, I'm going to retire 5 years from now. I say, please get off the roller coaster and go into a teacup, because I need to immunize your portfolio against the potential decline in its value. A lot of times people are very tempted to be clever about markets and say that, okay, let me read this information and then let me take the action, and I can save myself from the losses, I can reduce my risk, I can increase my return and all that. But timing the markets is not a silver bullet. It is actually a dud. And that means, firstly, it's difficult. Most professionals do not manage to do it. And later, Dr. Wei Dai will show you why that is so. A lot of people think that the economy and the market, there's some correlation. Actually, the economy is not the market. And we know that in previous crises, the market tends to turn about maybe 6 to 9 months before. The market is a leading economic indicator and not the other way around. And this is because markets are very efficient in pricing all the data and all the expectations of millions of participants into the prices. Second, is unnecessary, and I'll show you very soon why. And thirdly, you think you're being clever, but you're actually taking a lot of risk. It's actually dangerous for your nest egg for you to do this timing of the markets. On why being unnecessary, I'd like to show you this chart. Now, this is a diagram that is made up of little boxes, and it represents the annualized return of the S&P 500, which is the broad US market, over about 100 years from 1926 onwards. And here's how you read it. Each box represents the annualized return from the beginning of the year at the top of the column to the end of the year at the beginning of the row. So in that box highlighted there, you see that if you're invested in the S&P 500 at the beginning of 1928, by the end of that year, you have made a whopping 43.6% return. In the second year, though, this annualized return will have fallen to 14.7%. This is the annualized return or per year return. Overall is the total return over 2 years, 31.6%. Why has it fallen? Well, it was the start of the Great Depression. But you're still okay because you're up over 30%. But come year 4, you have lost all your capital and another half of it. And that's the situation that you see in color in red. Fast forward to the global financial crisis. If you're invested in the stock market in 2008, at the beginning of that, at the end of the year, you have lost 37%. This was the year of the Lehman defaults, banking crisis, housing crisis, and so on. But in 2009, or 2 years, your loss will have narrowed to an annualized negative 10.7%, or just over under 20% because of the very strong rebound in the markets starting from the first quarter of 2009. And by the 5th year, you are already in positive territory. So we zoom out and we color code this chart such that if the return is positive, it's green. If it's negative, it's pink or red. And the darker the color, the more positive and the more negative. So what's the first thing that you notice here in terms of the dominance of the color? It is mainly green. And what does this mean? This means that most of the time in the last 100 years, investors are making money in the stock market. So I hope that gives you great comfort as an investor, because it is a beautiful picture. Please take out your phones and take a picture of this, because the next time some guy on CNBC tells you something and you are scared, take it out and look at it. It's green, it's green, it's green, okay? So this is the first thing. The second thing is reds. Where are the reds? You find that the reds are not everywhere, like in the middle, or they are along the hypotenuse or the edge, which means that those periods of very negative returns or very big losses are short-term. 1 boxes, 2 boxes, kind of 1, 2 years. So that's another comfort to us. And in fact, I don't know if you could see, but there's a little patch of darker green somewhere in the middle, and you can see it's actually around the high inflation period of the 80s in the US. And this is because, once again, you say, actually inflation and market returns do not really have a big correlation to each other. And the final thing I want to point out is that you take find the longest stream of red and pinks and start to count the number of boxes, you discover something that if you can count, you count that the maximum is 15 boxes when you draw that parallel line, and then you're in the all green territory, which means that after 15 boxes or 15 years, in the last 100 years, if you had kept invested for at least 15 years, you would not have suffered a negative return. And if you exclude the Great Depression, this is actually 10 years. So I'm not saying that 10 or 15 is a magic number, but I hope that it gives you comfort that the stock market can go through a red, can go through a deep red, can go through some pinks and all that, but as long as you have time, the stock market will always recover and go up in the long run. Conditions? Well, you must have the ability to take risk. If you don't have 10, 15 years or so, we encourage you to take an assessment, and you might want to add some bonds to your portfolio. Secondly, that was the S&P 500. It's a broad, diversified market. Always recovers and goes up in the long run, does not apply to individual stocks. It's not apply even to the STI, which is 30 stocks. It does not apply to single sectors, as those people who have invested in the technology sector would know. And it does not apply to anything else except a broad, diversified market. Even the S&P 500, yes, it's US, but the companies are all global companies with global operations and therefore global exposure. And thirdly, keep your costs low, because those returns I show you are index returns. If your costs are too high, then you would actually take away from a lot of that return. The final D I said in that was dangerous. You might think that you're being very clever when you move in and out of markets, because after all, you still have the time, and it doesn't matter if you miss one or two of the up days, because you're trying to avoid the down days. But this chart shows you that even over a very long period of about 31 years, if you had left $1,000 in the stock markets in general, you would have made over $26,000. However, if you just miss 25 single days in those 30 plus years, not every year, in just 25 single best days, your return has fallen to about just 5,000 plus. Right? So don't jeopardize your nest egg this way. Sometimes the discipline of doing nothing is what works for us. Right? So don't itchy finger and go and watch these CNBC stuff and all that. They are selling news. Right? They want to sell you bad news. So they want to have viewership, and they want to have things that provoke you. And I call it financial porn. Right? So please take note that what really matters and what the evidence has shown is that staying invested is actually a very, very, very wise thing for most of us to do. And finally, a lot of people say, what about other kinds of asset classes besides stock and bonds? Isn't gold a good hedge? And what's the second one? Durians, right? Durians, in 2021, Musang King was 48 ringgit. I suppose it's per kg. And then in 1 year's time, it was 75. Very good if you're a durian producer. Commodities, right? Commodities, people feel that is something that is good with inflation. Or property. Nowadays, I don't have to talk very much about Bitcoin. At some point, it was deemed a hedge to inflation. I would like to say that there are some issues with all of these if they do not present that silver bullet to hedging inflation or giving you better returns in inflation. Well, firstly, you don't know You don't know when what kind of trajectory inflation is going to take. Is it going to come down? Is it going to stay the same? Is it going to go up? And a lot of these assets, they maybe as the exception of property, they don't have a productive return, right? They don't have that thing that I described just now about companies producing to meet demand and all that. So they are by definition assets of emotion, or we can call them speculative assets. It depends on who's the next guy that's going to buy it from you. The second issue is that some of the correlations with inflation are not stable. And even when they are a little bit more stable or statistically significant like with commodities, they're so much more volatile than inflation. So you're trying to hedge something, right? And then this thing is like 10 times, 15 times more volatile. It doesn't work so well. And in terms of property, I know Singaporeans love property and all that, but there's very, very chunky risk, and not all of us can afford it. So I think that for everyday Singaporeans, for most of us, and even for people who are more affluent, it is good to have that core portfolio with core staples in it of capital market instruments. By all means, if you have a high conviction about commodities, about crypto, about a particular sector, yes, learn about it and you can put some money towards it, but please don't lose your pants over it. So we recommend that if you want $100 to invest every month, maybe put $10 towards something that you like. And so, but if you can lose, if it's lost, your retirement is okay because you have $90 put in core portfolios that are evidence-based. Don't forget your CPF for Singaporeans. Now, a lot of times when people talk about integrating CPF, and we got a lot of flack from advisors when we first launched, they think that we're talking about taking your CPF to invest. And there are advisors who will tell you that everyone should invest their CPF and their OA or something. That is not true. The CPF investing is not for everyone. And we talk about CPF. I know that not everyone likes the government, but you can like the government's money. Okay? And in the special account, it's currently 4%, 5% for some amounts. It's actually the 10-year bond yield plus 1%, and then plus 1% for another portion. It is a very, very good risk-free return. And integrating CPF into retirement means using top-ups, using voluntary contributions to boost your CPF through its own innate compounding power. And there's a caveat though: top-ups, one-way street. Okay? No, you can't change your mind. There are three things that you can only have two of: liquidity, safety, and high return. Choose two. Okay? I think CPF gives you a high, almost risk-free return, but it is not liquid. So, but don't forget your CPF because it can be very powerful in compounding for your long term, for your retirement. So, I quoted Professor Ken French saying, risk is the uncertainty of lifetime consumption. But this uncertainty is not only found in your assets, it's also found in your liabilities or your risks or your contingent liabilities. And this is really, we need to talk a little bit about protection. Now, protection-wise, protection insurance is an expense. Insurance role is protection and nothing else. And what does inflation do to your protection needs? Because it increases expenses, if you're no longer around, you actually need a bigger payout for your dependents' expenses. And this means that actually you need to have more insurance. But at the same time, the good news is that actually insurance premiums for term insurance have been coming down a lot. And because you need more, all the more, you must keep insurance costs low. And how do you keep insurance costs low? By recognizing that for insurance that protects against your income loss, for example, your death or critical illness or occupational disability, you only need it for a term. So use term insurance. For how long? Until you have no more income to replace, which means until retirement age, or your last dependent becomes independent, whichever is earlier. Whole of life insurance, you really only need for whole of life needs, for example, hospitalization, chronic illnesses, cancer treatment. And for MoneyOwl, we also additionally lower your cost because we offer you a commission rebate. As it is, our commissions that we get are all kept at the firm level, the advisors are fully salaried, but we can further lower your cost this way. Just a word on investment-linked policies. If it's one word, I'll just say don't. Okay? It is not fit for purpose for protection. We don't have time to go into it right now. It's very, very high cost. Every year you're down like 4% before you can even start making money. So don't get into that. There are many, many ways to achieve your investment goals and your protection goals at much, much lower cost and much more effective. So I just want to put it here on a scheme for how long you need insurance. And when you recognize this, you know how to carry out this insurance philosophy we have, which is to buy as much protection as you need, but pay as little as you can. Sounds like a good deal. Very Singaporean, right? Okay, finally, in the third phase that we talk about, retirement. Retirement is this time when financially we no longer earn, but we still spend, and we'll have to spend more on certain things and less on other things. Now, retirement, there are actually 3 must-haves in retirement, and this is a fully paid house, something to take care of our medical expenses, and of course, an income to pay for our expenses. A lot of people always focus on the retirement income, and they go for Western research that says, oh, you need 75% of your last drawn income, and then they get very scared that they do not have enough. However, the context of every country is different. Not every country has 80% home ownership, like in Singapore. Not every country has universal healthcare. So let's go through each of the 3 must-haves. A fully paid house is a very good idea for retirement, especially in inflationary time, because you are immunized against rental inflation and housing inflation. However, you cannot eat the bricks of your house. So do not have all your cash tied up in your house. If you do, you might have to accept right-sizing or downsizing or monetizing your house in some ways through like a reverse mortgage or a scheme like that. In terms of medical insurance, Singaporeans, we are happy with B2 and C Ward. Actually, MediShield Life could do it for you. If not, then you need to get an integrated shield plan. The impact of inflation on insurance is that insurance premiums will go up as health expenses go up. So you also need to really think about whether you really want that private coverage or not. Now, in terms of the retirement income, the thing about inflation is that it affects anything that is fixed, anything that is a fixed income. So CPF, I said, is good in accumulation times, but CPF Life, the annuity payment that you get, does not hedge inflation well. So this means you need to further optimize your CPF. You need to build a buffer using investments. And for disabled living expenses, you might also want to consider long-term care insurance. So talk about CPF Life first. So CPF Life, well, now is a compulsory scheme, and there is a basic sum, full retirement sum, and an enhanced retirement sum that has a corresponding payout that starts from age 65 onwards, and it will be for life. So it doesn't matter how long you live, you will get this payout for as long as you live. And we encourage everyone to work towards the enhanced retirement sum rather than just the full or the basic, because the CPF is actually really the best annuity, all things being equal in Singapore. It actually killed a lot of private annuity. You could accept that you might have to work longer, or you could defer your payouts. If you don't need the money yet, you can defer them. Every year that you defer, the payout goes up by about 7%. And of course, this means that there's that inflation hedge, if you like. You can defer all the way up to 70. So this is about optimizing your CPF to take care of inflationary times. CPF and CPF balances in MoneyOwl's retirement system, we consider those as very safe income streams that we call the safe retirement income floor. Or sometimes we joke that we say this is the die must have income. If you don't have, you will die. Basically, it's for basic living expenses. Just now, I think we saw in the chart that it can be about 2,000 per person if you do an enhanced retirement sum. And if you consider it as a couple, this means that if both of you max it out, you could be looking at about 4,008 or so in terms of monthly income. And it's really not bad. I mean, even if that's not sufficient for you, it's really not bad as a first layer. There are other instruments then that you can build on top to supplement your income. I'll just go through them very, very quickly. Those are more for lifestyle expenses, more in terms of what you should look out for, not look out for. Retirement income insurance plans. They are kind of endowment plans. You pay in and then it accumulates for a while and then gives you back the monthly income. Returns are not high, maybe 3+%, but there's usually a floor such that your capital is guaranteed, at least in nominal terms. The the risk here is please be careful about all the offers the banks give you for premium financing, because as we know, interest rates do go up. Investments, a lot of people have this misunderstanding that once you are retired, you're in your 60s, you cannot invest. No, you can invest and you should invest, especially when there's inflation. And why do I say you can invest? You're 65 years old, but life expectancy is 85. So you do have some time. What you need to do is to take care of certain type of very specific risks to do with withdrawal. I don't have time to go into it now. You can read it on articles on our website. Things to do with the sequence of returns and what you need to know about withdrawals and how to control this, or at least mitigate this risk. And it should be possible for you to make your capital last for that time that you have. So do look into this because it really builds that buffer for you, especially in inflationary times. For the long-term care insurance, this is like Cashew Life. It pays out if you have some of very severe disabilities, and you can have plans where the payout increases about 2% a year as well. So these are ways in which we can manage inflation using financial instruments and planning methods in our retirement years. So let me finish by putting it all together, because we talk about risk, we talk about inflation, and you can see that inflation affects you not just in investments, but it affects you holistically speaking. So we need then a correspondingly holistic plan. A lot of times in Singapore, when we ask about financial planning, people say, what is the good product to buy? And people think that shopping around for products is financial planning. And it's not just consumers. The problem is that this is what the industry tells you. Oh, there's a financial plan. This is a great product. This is a great product. But how do you know that it's a great product for you? And how do you know that it fits into your plan? Because note that every dollar is being competed for by these different products. So they might be all very good products, but we have scarce resources. And especially if you don't have much, you do not want to make mistakes. So we please plan comprehensively, across the different time frames. And there are things that you need to do in inflation times. And of course, don't just think about assets, think about contingent liabilities in terms of insurance as well. Don't just think about commercial products. Start from CPF, what you already have. So I'll summarize that across all the time frames today, reduce your outlay, build your buffers, use fit-for-purpose and low-cost insurance. And when it comes to CPF, maximize it, optimize it. And investments-wise, stay invested, keep investing, use suitable low-cost instruments. Don't maximize, don't leverage, don't speculate. Right? Don't be too greedy on that. And in fact, I want to leave you with this thought that really, when we're talking about investing, we are not fund managers trying to beat some short-term performance, trying to be better than the other fund house. You're talking about your life goals here. And as long as you have sufficient returns, and those returns are reliable, they can enable you to live a meaningful life. And so I hope that with this mindset, and you can be at peace and have confidence to gain what you need in retirement or even now for today to live that best possible life that you can. Thank you.
Thank you, Chuin Ting. How many of you guys found that useful? Give a show of hands. Useful, right? I think and to me, I felt like the last slide, especially, thank you, Chuin Ting, for summing up so nicely, gives you guys 5 concrete action steps that you can take even before or when you leave the concert hall. So I hope that helps to put things into perspective for you guys. And if you are worried that you might forget some of the stuff that you have learned, I've also helped to document it on my social media. So you guys can go on my Instagram, SGBudgetBabe, and then check it out, okay? Or look at the hashtag on Instagram and you might be able to pick some of the stuff that other people in this concert hall today has shared. All right, so we saw a few of you guys asking about Mr. Lu. So unfortunately, Mr. Lu can't make it today due to unforeseen circumstances. He was unable to get on a flight back here in time. But he sent his regards. And if you guys have any questions that you initially had for him, you could put it into the fireside chat. And we'll try our best to see if we can get that to him. If not, one of our speakers will address it later on. Okay, we try our best. All right, so for the next section, I'd like to introduce to you guys Dr. Wei Dai. She is the head of investment research and vice president, leading the global team within the research group that conducts empirical research on a variety of investment topics, including drivers of returns, ESG, asset allocation, and life cycle finance. She works closely with clients to translate research insights into relevant, practical implications. So Dr. Wei has this gift of condensing and simplifying really like hardcore, nerdy, technical kind of academic research into applicable things that we can do. Okay, so I think you guys will find her session very useful. Dr. Wei is also a frequent speaker at Dimensional and industry events. And prior to joining Dimensional in 2014, Dr. Wei received her PhD in operations research and financial engineering from Princeton University. Her academic research focuses on statistical methods in finance and has been published in various journals, including the Journal of Finance, the Journal of American Statistical Association, and the Journal of Business and Economic Statistics. She also concurrently holds a BS in Mathematics and Applied Mathematics from Zhejiang University in China. So before I invite Dr. Wei up, just a quick reminder for you guys. Remember that in your event pack, there is a QR code for Pigeonhole. Okay, or you can go to pigeonhole.at and enter the code MoneyOwl. That's where you can input all your questions, and we'll try our best to answer as many as we can later on. Okay, you can also upvote questions that you see other people have asked, which you'll really like to see addressed. More votes, more likelihood that we'll talk about it. Okay, so and also for Dr. Wei's session later, do remember to switch off your mobile phones or silent it. Yeah, I think some of you guys got a bit distracted later on. We noticed some looks as well. So just a gentle reminder of house rules. But I'm not going to stand here and continue rambling anymore. Please join me in giving a hand to welcome Dr. Wei on stage. Dr. Wei, please.
Thank you, Dawn. Thank you, Dawn, for that kind introduction, and good to see everyone here. I've got my picture with Uncle Raymond, so definitely the highlight of my year. So definitely good to see everyone here. I have good news and bad news. Which one should we start with? Bad news, I heard some. Let's get the bad news out of the way. So Ting talked a lot about inflation, but that's far from the only concerns we have in this world. Right? If you look at the headlines, there's inflation, the Fed actions, the interest rate, recessions, and there's a lot about energy crisis, climate change, and thinking about geopolitical tensions. Tons of different worries in that world. Now, against that backdrop, this year has been a really tough year for investors. So here I have a graph. Each line shows the growth of $1 for each year. So there are some good years, right? That $1 goes up and up. And in years like this year, you start with $1, you end with less. And of course, we see some welcoming rebounds in Q4, but still on the equity side, you're probably looking at somewhere around 15% downturn. And the fixed income market is not helping either. So in fact, if you look at fixed income market since the 1970s, using some broad indices, the fixed income market has recorded one of the worst, or maybe the worst years since the 1970s. So looking around, so much volatility in the world, a lot of uncertainty, I think a lot of investors are worried, right? People are asking, what should we do to our portfolios? What does that mean for our retirement? Can I still have a good investment experience? And I think that sentiment is quite similar to what we have observed back in March 2020, not that long ago at the beginning of pandemic. I vividly remember at the time I was just back from maternity leave to work, and within a matter of a couple of weeks, the market lost a quarter of its value. And that's also the time when I did a similar event with Chuin, the last collaboration together. And this time around, I also came back from maternity leave end of September. Again, the market hit its bottom. So my statistics training seems to say that there's some perfect correlation between my own maternity leave and stock market downturns. If that's the case, the good news is that I've got a boy and a girl. I'm absolutely done. But joking aside, I think the real good news is something that Ting has shown you in her presentation. The downturns we are experiencing now, however painful they are the short-term noises, short-term volatilities that are bound to happen in your investment journey. And when you zoom out, you look at the capital markets have rewarded long-term investors. So not only these asset classes have outpaced inflation over the long run, but actually have grown your wealth even more for you to achieve your life goals and your family's goals. So what I'd like to cover today is how we can get from those bad news. Obviously, we have no control over a lot of those news, but to still a good investment experience. And I would say that requires you to have a different way of viewing the market. And then that will allow you to focus on things that truly matter. And I'll cover three aspects. All start with the letter D. Discipline, diversification, and dimensions of expected returns. And I'll explain what that means. Let's start with the investment philosophy, what I mean by viewing the market in a different way. I think you have already heard from Ting's introduction and also Don's words that we have at Dimensional have a different way of looking at the market. Our investment philosophy and approach is based on this belief in the power of the market and is deeply rooted in financial science. And that is an investment philosophy that we have held consistently since day one, which is more than 40 years ago for the founding of the firm. And with that investment philosophy, we have been very fortunate to work with institutions and financial advisors like MoneyOwl throughout these years to serve clients around the world, to bring that investment philosophy and approach to numerous investors around the world to give them that investment experience that they deserve. And altogether, our clients have entrusted us with more than $500 billion with assets under management. So just to explain that investment philosophy a little bit more, I think there's no better person to explain that than our founder, David Booth, and many of the leading financial economists that we work with very closely. Some of them are Nobel Prize winners. So with that, I'm going to roll a video and see what they say about our investment philosophy.
How is Dimensional different from other money management firms? I think the critical difference is the way we look at markets. We trust the markets. And over the long haul, that approach has served us well.
Dimensional is a firm that's dedicated to implementing the great ideas in finance. That's what we're about. The idea was a small company fund, and we went out and tested the idea, and we were able to get a few clients. Obviously, we had no track record. Our first office was my apartment in Brooklyn Heights. It was a 2-bedroom apartment. My brother had been living with me, and he moved out and used that second bedroom as the trading room. It was run on the thinnest of margins, and we didn't exactly have success written all over it. When you start a business, one of the first things you worry about is, and people say, oh man, everybody knows that. So I was particularly concerned about, was there research out there that we didn't know about, could be used against us? So my first phone call was to Gene Fama. I had worked for Gene as a research assistant and teaching assistant. And I called him up and said, look, here's what we want to do. And we invited him to be a founding shareholder of the firm and on the board of directors. We're blessed with working closely with Fama and French, who are largely the people that developed the data. One of the first things we discovered in running a mutual fund was that a mutual fund has to have its own separate board of directors. And so we thought, who better to monitor what we're doing than other leading academics? So we went over to the business school of Chicago and First person we talked to was Merton Miller, who eventually would get the Nobel Prize for his work in cost of capital. And we asked Merton to be on the board, and he agreed. Next door was Myron Scholes, and we went into his office and invited him to be an independent director of the mutual fund as well, and he also agreed.
I think of it more as an investment philosophy that draws on the academic community.
We think that distinguishes us from the other managers. In this process, we have, the best minds, the people that have developed the research that leads to these conclusions about dimensions. So we're very comfortable with our process and very pleased with the results that have been achieved with it.
I mean, basically, and I don't know anybody else that would ever have this attitude, they feel that they should just let us do our research. And if something comes out of that they can use, then they will do it. But basically, they think we're working and it can be profitable to them, even though it's primarily academic work.
Dimensional, unlike any of the big banks or others that you would think of, or even other fund complexes, was founded on finance science. So the culture from the beginning matched my culture.
I consider myself to be an incredibly lucky guy. Have had the exposure to these great people with great ideas, be able to implement them.
There are many other companies that have used our research without us getting involved. Dimensional, they're different.
It's been fabulous working closely with such talented people. And I think what's great as well is that the biggest beneficiaries of all of this, hopefully, are the clients. At the end of it all, it's about the implementation of the great ideas. And these ideas are much bigger than the firm.
Yeah, so as you have heard from our founder, David Booth, and many of the academics that work with very closely, that you see that we view the market in a very different way. We believe in the power of the markets, and everything we do is rooted in financial science and rigorous research. And that's different from many of the approaches out there. If you think about us comparing us to, say, a traditional active way of investing, that's what we are trying to illustrate using the middle box here. Oftentimes they're trying to pick which stocks is underperformed, undervalued, or overvalued, or try to time the market. But there's not a lot of compelling evidence suggesting that people can do that consistently after fees and costs. Because after all, nobody has a crystal ball about the future. But just like traditional active, our goal is still to try to outperform. But we're trying to do so by using the information that's already in market prices. We think of the market as a very powerful information processing machine. If you just think about the trading going on in the market globally, in equities only, you're looking at more than $700 billion changing hands on average every single day. And through all of that trading, all of that activity, information gets into market prices very quickly. Think about the headlines you read. Think about Wall Street Journal articles if you read those. Then as soon as you see them, they are already in market prices. So that means we can rely on the information processing ability of the market and then position our portfolios by using the information in market prices. And that allows us to try to outperform in a very systematic, risk-controlled, and cost-efficient manner. So that's some of the benefits actually we are retaining from pure indexing. So if you think about the first box, essentially you're tracking the market, thinking about just buying S&P 500 or some total market index. We think that's a good starting point because you're getting that broad diversification, low cost, low turnover. And in fact, some of our founders are the ones who are involved in the creation of the first index strategies back in the 1970s. But we think that we can do better than indexing, right? We can go beyond indexing by not trying to just settle for market-like return. By using the information in market prices, and I'll explain a bit later what kind of variables we use, we can position our portfolios for higher expected returns, while still maintaining a lot of the benefits of being broadly diversified, low turnover, and low cost. So in sum, what we're trying to do is to combine the best of both worlds, right? We start with the market, but we can do better by using this systematic way of investing. And everything we do is based on rigorous research and financial science. And if you look at our track record, I think our long-term track record definitely match our long-term research. So here we're looking at the percentage of funds that outperform over different trailing periods. If you just look at the bottom row there, these are about 20 years long-term track record. If you look at the industry funds out there, many of them are trying to time the markets, trying to pick the next winner stocks, but the track record is not that good. Look at a 20-year period, only about 45% of funds were able to even survive. So the funds you buy, 20 years later, they're no longer around. And only 1 in 6 funds were able to outperform. Whereas in contrast, if you look at dimensional track record on the left, all the funds that were in existence 20 years ago are still around. So the survival rate is 100%. And more importantly, we have an outperformance rate of about 88%. So that's a track record we're very proud of. But I guess the more important question is, how do we actually get to that track record? What are some of the important principles that we build our strategies around? And what are some of the principles that can be relevant for you as investors when you make your investment decisions? And that's what I will get to in the rest of my talk. And again, the 3 Ds, discipline, diversification, and dimensions of expected returns, or what we call the reliable drivers of expected returns. Now, the first one is the power discipline. That's something Ting already talked a lot about in her talk, so I'm just doubling down a little bit. In the end, you want to be in the market in order to capture what the market has to offer. Of course, it can be quite scary, right, in the middle of a downturn and to think about staying invested. So I think putting things into perspective can help. So Ting showed you that chart with a lot of the greens and some patches of red. Here's another way of looking at a century of ups and downs. This is the equity market. The orangish colors, these are the bear markets, meaning that you experience downturns of more than 20%. And some of the downturns can be pretty steep. And then the blue ones are the up markets. These are the bull markets where you hit new highs. So if you look into the history, there are about 17 bear markets in this sample. And so looking at a downturn of 20% or more is not something that's unprecedented. But what also jumps out of this graph is that when you look at bull market and bear market together, the good days definitely outshine the bad days. And more importantly, these markets returns can turn really quickly. If you don't stay invested and you miss out on some of the initial rebounds of the market, then it may be very difficult for you to catch up. That's why we often say it's important to stay invested in order to capture what the market has to offer. That's for the equity market. It's the same thing when it comes to fixed income. So I thought it might be interesting to give you some perspective on a balanced portfolio. So here is 60-40 portfolio, 60% in equities and 40% in fixed income. You might have seen some of the headlines saying, oh, now 60-40 is dead, right? Because equity is down, bonds are down as well. But if you put things into perspective, what we're seeing this year, about 18% down for a typical 60-40, it's not even in the top 5, or I guess the worst 5 periods of downturns. So we definitely have seen these downturns before. But more importantly, it's not just about where the returns have been, but where returns can be going forward. Because the markets are incorporating information every day, every minute. So the prices should be set such that the expected return of these bonds and stocks are positive going forward. And indeed, if you look at the subsequent returns of a 60-40 portfolio after a downturn of 10%, the next 1 year, 3 years, and 5 years, the returns have been pretty strong. I think that definitely gives us a case of optimism. And if you just think about fixed income alone, of course, the rising interest rates have led to some losses on the fixed income side. But the silver lining there is that now the yields are higher. Your expected return potential is also higher, right? So if you already endured the downturn, you might as well stick around in order to enjoy that higher expected return going forward. So that's about discipline. And what that translates to our portfolios is that we're working very hard every single day to make sure our strategies are consistently focused on the market and consistently focused on the asset classes and areas of high expected returns so that we are best positioned to capture those expected returns. Now, second D is diversification. Now, Professor Merton Miller, who is also a Nobel Prize winner, used to say, diversification is your buddy. It's something the closest to free lunch that you don't want to pass on. And why do we say diversification is important? Well, because at the all, nobody has a crystal ball. You never know where the return will come from, which stock, which sector, which country. Just to illustrate that point, here is what we call a quilt chart. Essentially, every color represents a country, and this is just the developed markets. And every year, from top to bottom, we're sorting based on the market's return. You probably cannot see anything, which exactly is the point. There's a lot of randomness in country-level returns. And some of the worst performer this year can turn into the best performer next year. And the range of returns from the best to the worst is huge. Just to look at the range here, now I'm only looking at the best performer in a year versus the worst performer in a year. Let's look at just 2022 at the bottom. The best performing market is Turkey, returning actually 48% year to date. And Turkey was the worst performer the year before. And the worst performing country this year is Hungary, down by more than 20%. So there's a big range, but if you also think about at the beginning of the year, the investment pundits talking about their predictions of the future, I don't remember seeing people talking about Turkey, Hungary, or anything like that, right? So in the end, there's a lot of unpredictable outcomes. And what you can do in order to not miss out on those positive returns is to be broadly diversified so that you're positioned to capture wherever and whenever the returns show up. And that's why in our portfolios, we have those global portfolios that give you access to more than 40 countries, developed markets and emerging markets. So you are best positioned to capture those returns. And the same idea applies to individual stocks, right? Within each country, you also want to be as diversified as possible and giving yourself the exposure to all the stocks in the market. Why is that the case? Because you never know which subset of the stocks will end up doing the heavy lifting. Just to illustrate that, here we have an index that's just all country. So you basically hold almost all the stocks out there. And over this long period of time, you're getting more than 7% annualized return. That's not bad at all as a starting point. But what happens if you just miss out on the top 10% of the stocks? Right? If you think about picking stocks or go in and out of markets, if you didn't have exposure to those top 10% of the performers, your return is down by 2/3. Now it's only 2.5%. And what if you miss out on the top quartile of performers? Now you're in a negative territory, negative 3.8%. So since nobody has the crystal ball about which subset of stocks will end up delivering that higher returns, we think the more robust way and more reliable way to do that is to expose yourself to all the stocks, to be as diversified as possible. And that's kind of a principle that we exercise in our portfolios, that we are broadly diversified across countries, across sectors, different industries, across all the individual names. In that way, you can minimize those idiosyncratic noises, those noise about those individual stocks or individual countries. And I would say that as an investor, there's probably no better time than today to be an investor, because you can get those globally diversified portfolios with more than 40 plus countries and thousands of stocks in one portfolio at a very reasonable cost. So the question shouldn't really be, why diversify? It really should be, why not diversify? And lastly, is the dimensions of expected return. Now, we've talked a lot about starting from the market, right? The market is a good place to be in. But it doesn't mean that everyone out there should just hold the market portfolio and settle for market-like returns. Just like when you think about lending money to, your in-laws, your friends, or Uncle Raymond, you probably will charge different interest rate, right? So it's the same thing when it comes to these securities. In the end, it will be really weird if all the securities out there, all the stocks, bonds out there have exactly the same expected return. So because there are differences in expected returns across securities, and that's what our research effort is focused on. How to find those systematic variations in expected returns to position our portfolios. And there, the framework we use is the so-called valuation framework. Essentially, if you think about buying anything, what should matter for expected return? Of course, your price should matter, right? The price you pay for your security, for your investment should matter. And what you expect to receive as a shareholder should matter as well. So that's why you should look at variables that's related to the price variables, whether it's market capitalization of the company or relative price of the company, as well as the cash flow side of the equation, meaning what's the expected future cash flows of company or what's the profitability of the company. And how should you get a higher expected return? Well, it's a combination of paying less and expecting to get more, right? That combination should be linked to higher expected return. And I remember explaining this concept to people, and my Singaporean colleague was saying, well, that's essentially the concept of cheap and good law. And that's exactly right. You need to pay a low price and expect to get more. And the combination of that will give you a higher expected return. And how that translates to the equity world is that you look at market capitalization, that's a price variable. So all else equal, smaller cap companies should have higher expected returns than larger cap companies. And you should also look at relative price. So for example, thinking about the price you pay, but divided by some fundamental variable, for example, the book equity. So then you might have heard the concept of value companies. So companies with lower relative price, essentially value companies, should have higher expected returns than companies with higher relative price. These are the growth companies. And lastly, you need to look at the profitability of the companies. All else equal, firms with higher profitability should have higher expected returns than firms with lower profitability. And focusing more on equity side, but it's the same idea when it comes to the fixed income side. We can also look at today's bond prices, today's yield curve, and understand which bonds and which segment of the bonds should have higher expected returns. And we do see those variations in expected returns across the maturity of the bonds, the credit quality of the bonds, as well as the currency of issuance. So I've talked a lot about the concept. And the next step for us is to get our hands dirty with data and see whether the historical data corroborates with the prediction of the theory. And the answer is yes. So this is a busy slide with lots of data. From left to right, we're looking at the US markets on the left, the developed markets outside of US in the middle, and emerging markets on the right. And from top to bottom, you're looking at these different sources of higher expected returns. So size, value, and profitability. So just to pick one, the one on the top left, I don't know if you can see the cursor, we're showing the annualized compound return of a small cap index, that's more than 12%, versus that of a large cap index, a bit more than 10%. The difference between the two is close to 2 percentage point annualized. That's the excess return associated with this size factor, or what we call the size dimension of expected return. So if you just look at these teal bars, you see that these excess returns have been positive and sizable, as well as pervasive across markets. So these are the factors, or what we call the dimensions of expected returns, that will build our equity strategies around. And essentially, we start with the market, and then we're going to do some over and underweight, and then we're going to overweight those stocks with higher expected returns. So essentially, those stocks that are smaller, that are cheaper, so lower relative price, as well as those companies with higher profitability. Now, of course, these are decades of data. In the US, you're looking at almost a century of data. So these are averages. You're not going to get that excess return every single year, every single quarter, right? So looking at averages is not enough. Just like Professor Bob Merton once said to me, my head is in the oven, my feet are in the fridge. On average, I feel just fine. So don't just look at the averages. The next slide that we always show to people is this one. What's the range of outcomes? What's the uncertainty that's surrounding that excess return? And so here, each bar represents a year. From top to bottom, you're looking at the equity excess return, and then the size, value, and profitability returns. So there are plenty of good years when those excess returns are positive, but there are also plenty of down years, right, when the excess returns are actually negative. And that's part of the investing. Investing, there's some uncertainty that's embedded in investing. Because if those bars are always positive, you may have to wonder where that excess return come from. It's because there is uncertainty, there is volatility that gives you a sense that why there is some relation between risk and return. And you want to be taking on the red risk in order to pursue higher expected returns. And knowing the volatility of these premiums or those excess returns, you may wonder, what can we do, right, in order to put odds in our favor? And again, there are a few things that I think are important. One, understand that you can't time these excess returns. We've done tons of research on that, and we don't see a compelling way to time these excess returns. In contrast, staying invested and staying disciplined will give you the best chance of outperformance. So just look at the equity market like before in the first column, or in the first box. It's a bit difficult to see. These are different holding periods, 1 year, 5 years, and 10 years. What's the probability of seeing a positive equity premium or when equity beat T-bills? You can see that over a 1 year period, that's about 70%. But if you have a longer investment horizon and stay invested, then you're looking at more than 85% over a 10-year period. It's the same thing when it comes to these excess returns associated with size, value, and profitability. And the other thing you can do, and it's also what we do in our portfolios, is to integrate these premiums, meaning that you want to have a portfolio that's relying on these multiple sources of outperformance. So that can also help you smooth out the ride, because sometimes the size premium is positive, but value premium is negative. So by relying on these different premiums in one portfolio, you're able to have a higher reliability of outperformance. And that's what we do in our portfolios, that every single day we're integrating these premiums, these different sources of excess returns, and we are making incremental changes to the portfolios every single day to give you that targeted and consistent exposure to a higher expected return. So in sum, what are the main takeaways for investors like yourself? Well, investing can be scary, right? If you think about all the headlines out there, all the worries, all the uncertainties, it can be scary, but it doesn't have to. If you have a scientific way of viewing the market, you can embrace that uncertainty and triumph over the long run. And having that investment philosophy also allows you to focus on things that you can control and do matter. And that's about financial planning. That's about having the discipline to diversify globally and to focus on higher drivers of higher expected returns. And if there's only one thing I would like you to take away with you today, is that read the news, read the headlines to be an informed citizen, but don't use those headlines to inform your investment decisions. And with that, I'm going to end with this one video.
The stock market on a rocket ride, blasting through a ceiling and closing at an all-time high.
Cheers of joy on the trading floor.
The internet revolution and the rise and fall of the internet stock bubble has become one of the most dramatic business stories of our time. In April of 2000, the bubble burst when the NASDAQ collapsed and dozens of dot-coms folded, losing billions.
If I'd have taken your advice at any point in the last 2 or 3 years, I'd have lost a fortune.
A huge percentage of jobs created has been because of the housing boom, whether it's construction, whether it's mortgage.
Bear Stearns is fine. Do not take your money out. This is rare. If there's one takeaway out of the
day, with Wall Street shaken to its very foundation, in market value today alone. The number is even more dramatic when you're looking at the
I want to make sure that we have good time left over for the fireside chat because we were just looking through the questions just now during the break, and there's so many good questions that we're kind of struggling as to what to shortlist to make sure it gets answered. So I'm going to jump straight into my section proper. My session doesn't have any research or academic driven because unlike Dr. Wei, I wasn't smart enough to study at Princeton. But I do a lot of other research, and what I do is to focus on what can be applied. And I'm going to be sharing with you guys that in this session. Okay, so what you're going to learn is how I and my family are tackling inflation. And throughout this session, you're going to get really concrete steps that you can apply. So if I were to ask for a favor, actually it's more of for you guys rather than me, as you go through and listen to the next few slides that I have, try and at least dig up or think about what are 1 to 3 things that you want to do. Because I'm going to focus a lot on the doing, but there's a couple of stuff. I'm going to give you like 9 to 10 things that you could possibly do. And I don't expect that all 10 are going to be relevant to you guys. So as you see it, write down or screenshot and then, add it on your phone, circle whatever that applies to your case so that you can remember to act on it after you leave this venue. Sounds good? Okay? All right, so let's start. Okay, so disclaimer first, I'm not your personal financial advisor. I don't know about your personal situation, but I do know mine, and I think what I have is quite reflective of the average Singaporean. So I hope that in sharing what we do, some of you guys also will be able to relate or find it useful to implement in your own lives. All right, so we keep talking about this inflation, but let's get some context, okay? How bad exactly is inflation? You're seeing all these headlines. Is it just noise like what we saw in Dr. Wei's presentation? Or is it real? Okay, now if we look at it, right, core inflation right now is like the latest headline says 5.3% in September. Headline inflation 7.5%. Scary or not? Scary, huh? So when you all see Chuin Ting's slide just now, you saw the plus 5%, right? You think about that being your expenses, it's like, oh my goodness, how? Okay, so the thing is we don't know whether this will persist or whether it go down. I think all of us want it to go down, but I think it's also quite fair to say there is a chance that we may not go back to such low inflation rates that we have enjoyed for the last decade. How many of y'all think so? Yes? Some of y'all, right? Okay, so the thing is we can think so, but we don't know whether it will happen lah. Okay, so whether or not it happens, here's one thing that we can do. Do you all agree that regardless of what comes, we can adjust our sails, right? So we cannot control the waters, the direction of the waters or the winds and where they bring us, but we can keep adjusting what we do to stay afloat and move in the right direction instead of letting it push us to the wrong direction or even worse, off the cliff, okay? And in inflation, right now, we look at the numbers in the past few months of this year. One thing that we can see is that it's going up. And we really don't know how that will look like in the next few months. But now what we do know is that it's high. And we better start acting now and not just sit on our laurels. How many of you here are guilty of not having done anything in the whole of the last 1 year because you saw like your electricity bill go up and you're like, I think it'll come down again lah. How many of you here didn't do anything for the last few months? Anyone? Some of you, right, it's okay, okay? Because you're not the only one. A lot of people also thought, it's only temporary. It's not worth my time to go and figure out what to change because, if I go and change my plan and all of it, then later it goes down again, then I wasted my time all for nothing, okay? But the last few months have showed us that it is time we start taking some actions. Do you agree? Okay, the action may not be permanent, but you have to take something. And what action you take is going to be focused on what impacts you the most. Because why? Now, if we look at inflation rates, it's easy to just see the headline numbers. But if you look at this, what it's trying to show you is that inflation affects every household differently. Okay, if you look at this chart right now, it says inflation weightage is only 5%. You all agree? No, right? I see a few people shaking their head already. Why? Because it looks like those of you who shook your head, you all have kids, right? If your kid need to go to school or it's in childcare or goes for enrichment, how many of you all have gotten that letter to say, "Dear parents, due to inflation, we're sorry to inform you that we'll be raising our rates effective of whatever month and year, and hence you'll be paying a higher price in the next year." Did you get a letter? Because I certainly did. Or if you didn't get it, what about your mortgage? Do you get a letter from the bank saying that your mortgage rate has now been increased due to rising interest rates? Correct? Or maybe the prices at your favorite restaurant or cafe that you used to frequent. And depending on what lifestyle habits that you are currently experiencing, you'll find the weightage affects you differently. So if you have no kids, good for you. Their education is probably 0. But if you have kids and they need tuition and they're not like a scholar, then your weightage is probably higher. Now, aside from all these that we can't control or cannot give up, the other thing we need to recognize is that inflation is also partially driven by our consumption and our demand. It's not just the supply chain shortage and the whole Russia-Ukraine wars and electricity disruptions that are bringing prices up. We have to also admit that we are partially at fault. Because how many of you here have just spent some money either on already going for a travel vacation, maybe you just came back, or you're planning to go for a vacation in the next 1 to 3 months? How many? Raise your hand. I'm raising my hand because I'm guilty as well. I just spent like 4 digits on my credit card to pay for a family vacation for my family in January. And I'm sure I'm not the only one. I see my friends coming back from Genting, Japan, Korea, Australia. I see them planning and booking. So if you look at this survey that DBS did right at the top, not my credit, they have shown that inflation and spent-up spending has actually increased from last year, 59% in May, to this year, it's at 64%. I can guarantee you this, if they do the numbers for this quarter or for Q3 and 4 this year, the numbers are going to be so much higher. Because a lot of us spend for the travel in these few months, right? So we contribute as well. And it's normal actually, because you can't say, but I don't want to be like rich, then I never enjoy life. What's the point of having money, then don't get to travel? Must spend also, correct? So we need to also acknowledge it's not just things that are out of our control, but also our choice. And inflation also is driven because household expenses are rising, but it's not always out of our control. So when you remember that nice line in Dr. Wei's slide, focus on what you can control, let's look at that in your own circumstance. Okay? But before I get there, let me share and put Chuin Ting's slide in the opposite perspective. Okay? If your expenses, how many of you think that expenses and what you pay for now, food, education, travel, how many of you think the cost will be higher in 15 years' time? Raise your hand. Everyone, right? I miss the days. The other day I was just complaining, right? Wow, the kiddie rides in the mall? My kids love them. I was telling my friend, I remember when it was 20 cents per ride. You remember that time? Now it's what? $3 I was shocked. 20 cents to $3. I won't be surprised if in 15 years' time, it'll cost parents $5 every time your kids say, Mommy, I want to ride that robo car or Paw Patrol or whatever the ride is. Okay, and it's going to go up and up. We cannot control that. But if inflation continues at 5%, I don't even use the headline rate of 7%. I use 5%. If that continues, we'll only be left with half of our money in 15 years' time. So let's put that into perspective. Almost all of you here earlier on admitted and raised your hand that costs will go up and be higher in 15 years' time. If you're not doing anything to make sure that your money is at least equal to, you're going to have a hard time paying for those expenses. Agree? Now, if you don't outpace that, you're also going to have a hard time. Agree? Because let's say you keep up, okay, so $1 now, you manage to maintain it at $1 in 15 years' time. But hey, your kiddie ride is no longer $3, it's $5 now. So your $1 cannot even pay for that kiddie ride anymore. So are you now seeing the importance of why you need to invest and not just aim to keep up with inflation, but outpace it? Okay, so now the truth is we don't know or not whether inflation will come down. And we have absolutely no control over that. The only thing we can control is what we contribute to the equation, which is our demand and our spending. But there are things that we cannot control, such as what the schools charge us, what the hawker or the restaurant charge us, or what SP services or whatever your utility provider charges you for consumption. Okay? But if you want a prediction and you believe in the White House, now what the White House says is that we believe the inflationary period after World War II is a better comparison for the current economic situation instead of the 1970s. Because a lot of people are comparing that, right? Is it more possible that we follow what happened after World War II, after Korean War, after the Iraq inflation, after the rising gas price in 2008, or the Great Depression? The truth is, we really don't know. But if you trust the White House prediction, this is what they say lah. Okay, so they say, we expect inflation to decline once supply chains are fully online and pent-up demand levels are off. Well, I hold a different view. My view is, I really don't know what will happen with inflation, but I do know one thing. If the companies who have managed to successfully convince you, let's say you were paying $500, then they send you the letter saying, dear sir or madam, I'm sorry, but due to inflation and rising labor costs and supply chains or whatever it is, your $500 now will be $700. And then you pay. Do you think 1 year later they'll send you a letter, dear sir or madam, thank you for being with us through the hard times as you paid us $200 more. We're happy to tell you now that you can now pay us $200 less. We're going back to $500. Yay! How many of you think that will happen? Raise up your hand. See? Nobody. Why? Because let's be real lah. If you run a business, you manage to convince your customer to pay for more, why on earth will you go back to asking them to pay for less, right? You keep it there. So, I don't think inflation will ever go back to the low levels that we had in the past. Okay, because Apple products have gone up so expensive now, they're not going to drop their price or not going to drop it significantly once supply chains stabilize. So, what can we do during this period while waiting for more concrete information to come out about the future? There are 3 strategies. Okay, so this is where I want you to think about what applies to your case and then do it later on. First, reduce, next optimize, and then earn more. Let's talk about them. Okay, so reduce. If you've been guilty of eating out more often, I'm guilty of that, then eat at home more often. Okay, it's not only healthier for you, but also you can control your costs a lot more. Because groceries at the end of the day cost a lot less and you don't have rent, labor, or marketing costs built into the food that you eat at home versus outside. Okay, if you can, go more for hawkers or food courts instead of restaurants, because I get it. It's not feasible for everyone to do homemade prep, right? We're all busy folks and some of us juggle multiple roles at home. It's quite difficult to keep preparing our food. So you can at least go for lower cost options. Or here's one thing that I found myself doing a lot more. And some of you may have seen me on TV talking about this, but there's absolutely no shame in using house brands. Because you know what? Unlike house brands of the past, where the quality was like, meh, and people were like, use a budget. Nowadays, everyone's struggling. People are going towards house brands, and the quality of house brands has gotten so much better. If you have followed documentaries that interview like the big supermarket chains, FairPrice or Meadows, Dairy Farm and all of that, they explain to you where they get their sources and their products from and why they can offer such good quality of their house brand but at such a discount to the branded options. You'll understand why you're really getting good value. Okay, so if you think that's going to be helpful, I have articles on that, but I'm not the only resource. There's plenty of marketing materials as well that you can find. But here's the thing. Because house brands are more affordable, they don't have the marketing budget to tell you to buy them. So you need to own self look out. Okay, so it could be like the FairPrice brand of milk or the Meadows brand or whatever. There are a lot of house brands out there. Check out and compare with your usual brands to see if it makes sense for you to switch. Okay, I did an experiment by having 2 cards, one with house brands only and one with the branded option. Diana Sir did the same experiment for a CNA video, and we all came to the same conclusion. You'll easily save 30 to 40% of your expenses. Does that sound good? I did promise you earlier on that if you stay for this session, you will walk up in a better financial situation, right? 30 to 40% more easily in your pocket. Okay, just by this one tip. Another tip, if you are using credit cards, okay, please, I hope most of you are not on debit cards, but if you have reasons for not wanting to touch credit, I can understand. But if you know how to use credit cards, right, okay, you can actually get things like cashback and miles and reward points, even for your bills and utilities. All it takes is 5 minutes of research on Google to find what is the best cashback/miles card for electricity, for petrol. And just doing that and then getting that card will put you in a better position already than using the default card that you're always very lazy and just keep going back to. Okay, so just that short research can get you more as well. So you learn to use the right card for your expenses. Not only do you get all these rewards, but you can also make use of one more thing and layer it on: memberships. Okay, so if you shop at a particular retailer or a particular group of retailers, you can make use of their memberships. So some examples, if you're an NTUC fan, then Trust Bank and their series can give you a bit of discount, right? You all may have seen the ads already. If you shop a lot at, say, Meadows, Cold Storage, 7-Eleven and Guardian and stuff like that, then the Yi Rewards program could be beneficial for you. The thing is, there's a lot of these reward programs out there. Even Pasta Mania has their own reward program. Okay, but how to choose? Don't fall into the opposite trap where you sign up, then you get lured by their marketing materials. You need to start with what you're already consuming and then finding the appropriate membership for that and thinking, does it make sense for me to go for that membership? If that membership, if where you go is only 1 out of the 5 partners in their membership, then maybe don't waste your time lah. Because you sign up for a membership, but you're not going to use for 4, but you're going to be swarmed with advertisements for the 4 all the time. If you can control, that's great. If you cannot, then don't. Okay? So memberships are great. And then the last one, my favorite, earn more. If you can, if you're pulling your weight in your job, go and ask your boss for a raise. You can prove it. And there are resources online teaching you how to ask your boss for a raise. Okay? If not, if your boss cannot have that conversation with you, or you are too afraid, or you're not pulling your weight, so you're actually like laying flat, then what you could do is also consider building an additional source of income. And there are many ways of doing that. Okay, so explore what works for you. And lastly, if you have savings sitting in the bank, please, I hope for the sake of your money, do not let them continue to earn 0.05%. Okay? There are ways that you can earn more than 2%, 3%, or even an easy 4% today. If you don't know how, I've talked about it on my blog. Okay? But if you just spend some time researching, you will be able to find these options. So make sure you don't let your savings get eroded too much by inflation simply because you were lazy and just let it sit there. Okay? So these are 9 things that you can do, but there's more. Okay? Because if you really want to outbeat inflation, you need to invest. Now, the problem I realize with many people, and in my conversations with many of my readers and you guys, I see some familiar faces here, I realize that a lot of you spend a lot of time on the left side, right? You queue up and you do the Singapore Saving Bonds laddering strategy. You're going to apply for T-bills. You camp every month at the MAS website looking for the yield. But hey, guess what, guys? That doesn't even help you to beat inflation. Do you realize that? So why do you spend so much time there? Shouldn't you be spending more time on what can actually help you beat inflation and not underperform it? Okay, so we need to move more towards the right-hand side. Now, I know it seems scary, but fear also comes because of ignorance. And what you can control is to become more knowledgeable. Coming for events like this, learning from really smart brains like Ting and Dr. Wei, learning about what other people are doing, can help you contextualize and understand what to apply for your own case. So, how to move towards the right? Let's talk about the left first, huh? Really, you all look at the yield very good, meh? And then I tell you all something funny. In the online sphere, everyone started talking about T-bills in recent months. You all got to see, right? And then everyone started going there. Then what happened in the latest trench? Everyone thought you'd keep going like that. Then what happened? Down. I don't know where you'll go next. But you see, that's why I don't spend so much time on just the left-hand side. move more towards the right. Okay? Now, the other problem is that you are not always guaranteed fulfillment. The Singapore saving bonds and T-bills are great, but hey, how many people you all know got the whole trench filled? Most people only got partial allocations, right? So don't spend too much time there. You really need to go more into things that will give you more. Okay, fixed income. I just do a very quick overview. Today, there are really good options. Even just this morning, I was alerted by a friend that a particular bank is now giving 3.9% for 3 years. Lock in. How many of y'all want to put in your money and throw away the keys to a bank for 3 years? Cannot touch, huh? So if next year, someone in your family kena something or you need it for urgent, or you suddenly want to go on a family vacation, you cannot touch the money. Does that sound good to you? Now, it does if it's extra money. But 3 years lockup is also very painful. And I think if you want to lock up your money, you should be demanding more returns on that money. Okay, so there's all the different yields out there. You can go and take a look. But please, my advice is don't spend so much time here. Spend like maybe 1 hour and then cap it there. Then more of your time on things that will outpace inflation. Okay? Next, is gold a good investment? My caveat here is I don't know a lot about gold. But what I do know is I think if you see gold as an alternative asset class, then it is also worth spending some time studying it to see if it makes sense to add it to your portfolio. And if you don't know how, then either don't touch it or talk to financial advisors who do know about it to get a second opinion. Then you can make your own decision. Okay? How about endowment plans? Now, these sound great, but if you were to lock in your money, does that sound good to you? How many of you don't want to lock in your money, but you want to get around this kind of returns? Anyone? No one? That means if I tell you that you can get returns like this or better, but you don't need to lock in your money, does that sound good to you? How many of you want? If nobody wants that, I'm not going to tell you. If you all want, I tell you. Okay, I see a few hands, 1/3 of the audience now. Okay, let me tell you how. I'm not being paid to say this. Okay, disclaimer first. Why Saver? MoneyOwl. Okay, it's not very often marketed. Right? You all don't see the ads for it because why? MoneyOwl at the heart of it is a social enterprise. So what that means is they don't spend a lot of money on marketing. But I think if you all have been following the scene quite closely, you realize one interesting tidbit. The other day, I was just talking to a reader and she was complaining, hey Dawn, how come when the market was very good and going up in the last 2 years, a lot of financial companies, we won't say who, were doing a lot of marketing. But we all know that people should be more aggressive or continue what they're doing in the bear market. And we're in a bear market now, right? Then why are everyone else staying quiet? But yet, MoneyOwl is here today organizing this event. I think if you watch and start to look at what is being done instead of where the money and marketing always goes, you'll start to see certain patterns. Something that will only emerge with time. And with MoneyOwl, you're not going to see them promoting this all the time. They're certainly not going to take up like big ads on TV and expensive ads around Singapore because why Saver? It's a very safe way to grow your savings. And if you look at what the product is, we can talk about it later on as well. Right now, the 5-day moving average as of 25th November, just a few days ago, is 3.68% per annum. See, I did promise you, right? More than this, but don't need to lock up. Got the answer already? Okay, now why? Let's find out why. This was the question in the Q&A as well. So you get higher returns than retail deposits and you don't have to worry about your money not being accessible. Okay, where your money goes is that it gets deposited in Singapore dollar bank deposits mainly, which are offered by local financial institutions. So the biggest worry is, will these players collapse? So if you think the big local financial institutions will collapse, then you don't touch this. Okay, but if you think that way, then I also will question, then why you leave your money with them in the savings? Okay, so next, liquidity. There's no lock-in. You can get your money out in as short as 2 business days. Okay, there's also no sales charge, advisory, or platform fee to keep the cost low as possible for you guys. And finally, if you all recognize the name Fullerton Fund Management and you look at their track record, there has never been a negative period of return in history. Of course, never say never. But the fact that it has never had in the history shows that the odds of having nicks are lower. Not zero, but lower. Okay, so if you go and study the product, you'll understand how it works, then you can consider if this definitely makes more sense and beats these kind of options for you. Alright, so enough about that. Now let's talk about what tools you should use. So, If you play too safe, like I said, you spend all your time on the left-hand side, which most Singaporeans are very guilty of, you will not outpace. Because you see on this table, I know there's a lot of information, but focus on the bold ones. And right in the middle, can you see that equity funds and balanced funds tend to outperform? But if you look at the red ones, if you leave your cash in a bank, in a locker, under your bed, in a biscuit tin, you get 0%. Or actually not 0, it's negative. Then, if you leave it on your savings account, it's 4%. Actually, in Singapore, not really 4. You never do anything, it's actually 0.05, okay? And then, if you leave it in bank deposits, fixed income, you're really only getting like that low percentages, which are not enough. So, learn to start reading and understanding more about how investment works. And then, I know it's scary, but we need to start and overcome that fear by bridging the ignorance gap. And it takes humility to admit to ourselves, not to your loved ones, but to yourself, that maybe we could do by learning a little bit more, and that we don't know everything there is to know in this world. Even for me, even though I study all these as part of my work, my side hustle actually, but I always still learn. There's so much to learn, so much new things and insights to think about. Okay, and when you recognize that, that's when you start to get a chance of outperformance. So what tools to use? You all can decide. Asset allocation, you all can decide. There's like 60-40. There's so many different variations out there. And like what Ting said, it should be reflective of your situation. So if you don't know how, you can speak to a MoneyOwl advisor to kind of get some opinions on how you can structure that. But stocks and bonds, especially stocks, equities, stand the biggest chance of outperformance. Okay? Now, why? I know it's scary. How many of you have your portfolio in the red now? Anyone? Most of us, right? Actually, if you have even invested, even Dr. Wei has raised her hand. Why? Because it's not that you're not skilled, guys. It's because that's the market today. Or maybe it's because you weren't as disciplined, or you invested in the wrong stuff, or you over-allocated to the wrong stuff. Now, there's different reasons for all of us. But if you're in the negative, it can feel scary. And it's basic psychology that all of us want to catch the maximum possible returns. Today, on my way here, I was just chatting with my group of friends, and we were all talking about how Hong Kong, China has had a great rebound in the last few days. Agree? Do you all see the news? And then my friends were saying this. Okay, I was saying, wow, thank goodness that my trench on this stock got filled right before the rebound. And my friend said, oh, is that all? Then I said, and I regret that I still have some cash that haven't been allocated. I don't know if I missed the boat. Okay? And my friend said this, you have. And I said, why? Why you say I missed the boat? And my friend said, because if you had caught it at the lowest at $200, today is $290, this is your gain, 40%. But you never catch. So too late, you missed the boat. Then I asked back in return, in the whole of this year, $200, the chance to buy at $200 only existed on one day. 1 out of 365 calendar days. Okay, minus X number of weekends, so trading days. How many of y'all think that you can catch that 1 out of 365 days? Anyone here? Cannot, right? And the reality is, it's almost impossible. Why? Unless you tell me, hey, Dawn, I got cash. You know why? I DCA, dollar cost average, every single day. Then I'll say, are you crazy? Your brokerage fees and commissions you pay every single day? That's just insane. Why don't you do like once every month? I don't know of people who do every day except for like the big fund managers and hedge funds because they are playing a different game. So it's very easy for human psychology to want to always time the market and catch the bottom. And we are by nature risk adverse. But when we get blinded by greed and we hear stories of people posting, hi guys, I'm going to teach you how to get the next 5-bagger. Or, hi guys, look at me, I'm the YouTube guru, and I'm going to teach you now how I have gotten 100% on my investment and how you can do the same. It's very tempting to fall into that trap and make that mistake of allocating way more than you should have to the position that you saw being recommended. But as we have seen in the last few years, what often is popular may not always be the right move to make. And you can make that move, but the allocation is very important. And allocation is something that's deeply personal because $1,000 means different to you versus you, right? So you need to make that decision and own that for yourself. So let's go back to understand the basics. Okay, and this is my biggest, most important message for all of you today before I end off. Last 2 slides. Okay. Why equities will outperform? Very simple. Because like I said earlier on, if you're a business and you successfully convince your customers to pay you $700 instead of the $500, you're not going to bring back down that price. Maybe you will, but you'll be like $650, guys, so you get $50 off. Aren't I nice? You still earn more. And because of that, okay, when rising inflation leads to a rise of price and cost, companies that are strong to pass on those costs to their consumers will stick with that. And when the cost supply chain start to stabilize again, they are unlikely to put down their prices as much. So the profit margins will then grow. So the only way you can write off that is if, number one, you own that business. I want to just curious, how many of you here own a business like that? You already asked your customers to pay you more and they agreed. Anyone? Nobody. I also don't have. I also want. Okay, so never mind. I tell you all the other way. You don't have, you can be a shareholder and be invested in businesses like this. Okay, and whether you take the approach of broad market diversification or allocate some to individual stock holdings, whatever your approach of investing is, only when you invest in strong equity companies like that are fundamentally strong, earning these profits, will you then get a chance to beat inflation and create wealth for yourself. And then you'll achieve that holy grail that Chuin Ting talked about in her slide. In retirement, you'll have not just a fully paid house, not just your insurance that covers you for medical and long-term needs, but also the income to continue well into your retirement years. Okay? And with that, I'll end off with this slide, which some of you may already seen, because it's one thing that I always repeat in every single seminar and webinar and event that I do. But timing, the market is that. Time in the market is what matters the most. And right now, we're at a time where it's scary because it's rate. And it's very easy to run for the doors right now. I think if we did this event during the bull market and we titled it, How to Get 10x Returns instead of How to Beat Inflation, instead of How to Beat Inflation, I bet this lecture hall wouldn't be enough for the attendees who want to be a part of it. But when we do an event titled How to Beat Inflation, it's more boring and people are like, I don't want to just beat inflation, I want to get 10x. I'm not going to spend my afternoon learning about how to beat inflation. They think they know better until their returns show otherwise. Okay, because they're always trying to time the market. Until the day they realize and humbly admit to themselves, it's really, really very, very difficult. So the earlier you realize this and implement that, the better off you'll be. And with that, I hope you guys have taken away at least 1 or even 10 things out of my presentation. And if you have any questions, submit your questions and we'll go into the fireside chat shortly. Thank you. Okay, so we have about 20 minutes for this fireside chat. We'll try our best to go through all the questions, okay? Not to scare you ladies, but there is a lot. So we'll try our best. Okay.
I'll try to speak fast.
Okay, we'll all try to speak fast, okay? Okay, so first question. Some other platforms claim they're the most low cost and we should go with them again. Is MoneyOwl low or lower cost? I think this is a question for Chuin Ting.
I would say that we're not really interested in being the cheapest, but we are definitely, I think, one of the lowest costs, especially for everyday Singaporeans who want to invest a small amount of money or start somewhere. That's our mandate as a social enterprise. Actually the best way to achieve the lowest cost exposure is not to go with any advisor at all. If you are very good at DIYing, you don't need advice. Just go and buy something, with a few basis points on the, through there are many discount brokerages and all that. So I think you need to recognize that low cost is very important, but there is there is an alpha that comes from being with an advisor. Right, and that's been proven a long time that if you don't need the risk coaching, you don't need the asset allocation, then why pay an advisor? So I think it's really more the value that you find. If you find that what MoneyOwl does is of value to you, then you'll be very glad to be your advisor. But if you find that you don't need it, then why pay more? Yeah.
Thank you, Chun Ting. Did that answer your question to all those who put that in or upvoted that? Okay, the next one. I'm just going to go with this as well because I think Dr. Wei and Chun Ting can help. So, what are your recommendations for people who have already bought life insurance and ILPs? Should they switch to term and terminate ILPs?
Okay. Well, firstly, you need an advisor probably to help you to look through the what these are, and please do contact us. It's not so easy because a lot of these ILPs come with very huge lock-ins, and if you terminate earlier, you might actually lose quite a bit, and that was part of the idea, right? So there are a few options. One is that you might be able to put it to what you call paid up option. Paid up option means that you stop paying into it, and you let the policy sort of lapse. You could do a calculation and see whether it's worthwhile. So we have some clients who actually decide to surrender, and some don't. There are two types of ILPs, roughly speaking. One is what you call 101, in which you get the protection of only 101% of your value of your units, and these tend to not have very much protection, but at the same time, they tend to have locked you in because it gives you bonus points, bonus units, can be up to 80% or so. And there's another type in which you actually have a deduction of the protection premium of your premiums. So you find that, over time you're paying so much more. So for these, actually, we have colleagues who actually have put them to paid up status. So what happens is that you just let it deduct after a while. But be careful when surrendering any policies, be it whole life or ILPs, because a lot of times, if you don't have the medical condition to be insurable anymore, you might just have to stick with it. So I think perhaps you just contact us and let us see how we can help you. There are various options, but it depends a lot on the terms of the policy. I think what I'll say is that we do encourage you that to look into whether you have sufficient coverage in the first place, and term insurance is actually getting cheaper. It's one of the few things that got negative inflation, right? So that's the thing that you can look into, especially towards the year end when you do financial planning review.
Thanks, Chun Ting. So, wow, that's quite good, right? She taught you how to DIY yourself if you don't want to talk to anyone on what to do and you're the one who asked that question. But at the same time, if you want a second opinion or you don't know how to DIY even after hearing that, then you could try speaking to one of MoneyOwl's advisors to get that second opinion. Thanks, Chun Ting. Okay, I am going to get in two questions at once. So, the first one is, why should I invest dimensional fund instead of S&P 500? Wait, but that is almost the same as this. What is dimensional fund performance compared to the S&P 500 after all the management fees are included? Does dimensional outperform? Dr. Wei?
Okay, I'll start. So I think S&P 500 or some other, kind of market-like indices are just a proxy, right, for what the market, the index fund and the market returns. I think there are two things mainly. One is, what is the objective? If you invest in index fund like S&P 500 or some other world equity fund, then your goal is to match the market return and minus fees and costs. So you're getting below market return because of the fees. And for us, our objective is always to outperform the market. And we're doing so in a systematic and risk-controlled and cost-effective manner. So that's the objective. And the drivers and kind of the premiums we pursue are driven by the rigorous research we do. But second is also the implementation. If you think about the index funds, it may be getting a little bit more technical, but oftentimes they say rebalance once a year or a couple of times a year. So you're basically doing the maintenance of that portfolio only a few times a year, and you're buying all the stocks and that go into the index and selling the stocks out of the index, just like when everyone else is doing that when they're tracking the same index. So that means you're not going to get very good execution. Just think about, buying roses on Valentine's Day. you are going to be a price taker. You're probably going to pay a much higher cost. And for us, our funds, we have a daily process. So we're making incremental changes every single day in order to keep that consistent exposure on higher expected returns, but also means that we have that flexibility built in order to get the execution done as cheap as possible. So I feel that's also better implementation. If you're going with the index route, you're busy leaving the money on the table.
Thank you, Dr. Wei. I'm going to add on one more to that. So the S&P usually is the US benchmark. There's a question here on what's the difference between investing in the MSCI World Index versus dimensional funds, when the poster is saying it seems like returns are only mirroring MSCI. Your thoughts?
Maybe I should also add one thing. Like you said, S&P 500, these are just the largest stocks in the U.S. So they are an important part of the market, but there's a lot more out there, right? So the U.S. market is probably only 50% of the world. So it's a lot more opportunities you can invest in. So if you think about also smaller cap companies and the stocks outside of U.S., so there's plenty of investment opportunities. So if you truly want to be globally diversified, you want to probably invest in all the 40 plus stocks out there. And if you think about the global portfolios, we have thousands of stocks, not just the 500 biggest ones. And then here, I guess you are going one step further, right? You're using the MSCI World, so you're getting more stocks. But again, it's the same thing. You're settling for market returns minus fees and expenses. Whereas for us, our starting point is the market, but we try to get more. Of course, like we said, those excess returns we're pursuing, it's not every single day, every single month you're going to get that average. There is going to be somewhat a little bit of volatility and bumpiness in the road in order to get that long-term averages. So that's why you have to evaluate, how much you want to focus on those higher expected returns. And then we have a lot of portfolios that have more kind of moderate tilt towards those higher expected returns, which I think could be quite suitable as a core allocation in clients' portfolios.
So maybe I'll address from the S&P 500 versus the implementation and perhaps the world allocation first, okay? So I think that we need to compare apples and apples. So I think for dimensional versus S&P 500, it has to be a dimensional US fund versus a S&P 500. And S&P 500 is not investable as an asset class. As an instrument, you need to find a fund that tracks the S&P 500. So firstly, does the US market always outperform the global markets? And global markets, the last 10 years they have. And it was very interesting for me because I saw that there are some advisors, they sort of had a world allocation and they decided that it looked better on historical returns to overweight the US. So because, 10 years, actually it was quite good. And they could project 10+% based on historical return. But, everything sort of takes their turns. Right? So in the same way as tech, in the same way as US, it depends on the time frame that you're looking at when it comes to global versus US. So I think the jury is out. It really, really depends. It's the same way that Asia actually was outperforming for the longest time, and then actually it took turns and it was no longer outperforming, and US was outperforming. So please be careful when you look at historical returns, because a lot of times there's a lot of cherry picking when it comes to presenting historical returns. So you need to have the investment philosophy of global diversification. The MSCI World is actually developed markets, of which I think US, I believe, is about 60%. The dimensional portfolios that we use on the equity side, we follow the allocation of the MSCI All Country World Index, which is 88% world and 12% emerging markets, which is where your China and all that are. So firstly, allocation-wise, I think it really depends. There's nothing to say that the US will always outperform. S&P 500 will always outperform. And I think the last few years have shown that it has gone up and down. In terms of implementation, I think we need to be careful about how do you access the S&P 500 in Singapore. How do you access the S&P 500 properly? If you want to buy it off the US ETF, of course, it's very cheap. And you can argue that, this is what is probably the cheapest way. Of course, there are withholding taxes. There is foreign exchange. There's a lot of friction when it comes to buying ETFs and all that. So you need to be aware there are a lot of hidden costs that are not obvious to you. Whereas in the dimensional funds that we use is cost efficient in terms of it being in Ireland, domicile in Ireland, and so on. So it really depends. And the S&P 500 in Singapore, if I'm not wrong, can be accessed through a synthetic ETF. Now, synthetic ETF we don't really recommend because the synthetic ETF on the STI, it means that they don't replicate they don't actually physically buy those stocks. It's really synthetically replicated. There is one fund that is a wrapper, the Infinity S&P 500 fund, but the kind of total expense ratio, I think, is really very high, kind of 40 basis points or so. Now, dimensional, I'll see it this way. Dimensional, especially the core portfolios that MoneyOwl uses, you take the broad index and then you add the tilts towards the various dimensions. So if we should be able to get the broad market return and a little bit more with the option for outperformance, right? But for the option, actually, you don't pay very much more because the dimensional funds expense ratios are generally about 30 basis points or lower, and we can't really access the S&P 500 or the index funds that cheaply in Singapore. Yeah, so I think that a lot of times we need to look beyond historical returns. We need to look into the implementation as well about where it is, and at the end of the day, also the philosophy. Whether you believe in the logic and the philosophy and the evidence that underlies each strategy.
Thanks for elaborating. So I hope you guys understand the approach better, and then you'll be able to decide what's better for you guys. All right. Okay, the next one. I'm asking all the hard questions. I have been a MoneyOwl customer, not me, but since June 2020. And dollar cost average $300 a month in a 60 equity, 40 bond portfolio. This portfolio is currently in the red. How will MoneyOwl's new portfolio help?
If it's a 60-40, it should be a balanced fund. We do not change our portfolio allocations based on the macro environment because we don't believe in the tactical asset allocations. I think firstly I want to say well done to you for investing regularly. And if your 60-40 is not in the red, then actually I'll be in trouble because it means that I've not been following what it has been in the market, right? So I'll say hang in there. I mean there are many of us who are in that situation, but if you press the button now, like I said, you are missing out on the markets being also on sale. The beauty of dollar cost averaging is that when the markets are down, you're actually buying cheaper. Right? You're buying cheaper, so you get more units for your dollar. And when the market recovers, you make it all back and more. I think the 60-40, we've seen the resilience of the 60-40. And sometimes when it's, if I'm not wrong, you probably only went into the red this year, because of the volatility in the markets. And that is to be expected. Right? So continue investing. In fact, if you're dry powder, we actually encourage you to go a bit more. If not, at least stick to your plan, right? Don't let the markets derail you from your plan because you know the evidence and the logic of the long-term return of the markets.
I guess to recontextualize that, it really is a reflection of the broader market performance right now, rather than questioning the strategy. And as long as you understand what the strategy really is about and why you implemented that, then one possible action to take now would be to increase your DCA allocation, or at least just stick with it instead of running for the exits. Because running for the exits now could possibly do more harm and put it more in the red, while you miss out on the possible rebound when the markets turn, which we don't know when.
At MoneyOwl, we are not going to, we do not do things that are against this philosophy, right? We believe in markets, we believe in the long-term potential of markets. Please, if ever, MoneyOwl does that, if you're saying that the market 60-40 is in the red and you're in the green, then you really need to come and ask what are we doing? Because we have advisors who do that, and we do not even choose, and we also choose fund managers like Dimensional who do not do that. Right? If if I say that, oh, I'm staying invested, I'm helping all of you stay invested, all the end dimensional goals and that's funny things and all that, then we'll drop dimensional from our team, right? You must have both the advisor believe in this philosophy and your fund managers must believe in this philosophy, that you are not forecasting, you're not changing your asset allocations on thinking that you're better than the market. Yeah. So hang in there, well done. Continue DCAing, and you will see the light at the end of the tunnel when the rebound comes. When the rebound comes, you won't be able to catch it. It can be very fast and it can be strong.
Okay, next question. I'm going to turn the spotlight back on to Dr. Wei. How is Dimension able to charge low fees when other hedge funds are so much higher?
Well, thank you for noticing how how competitive we are on the cost. I guess, specific to hedge fund, you kind of need to ask where the costs are coming from. Because oftentimes the hedge funds are trying to find, mispricings in the market or try to time the markets. Oftentimes you need to hire a big army of analysts and try to have some arms race on supercomputers and trying to be smarter, and in order to find information that's not yet embedded in market prices. That's very competitive to do, and that's very costly to do. And we haven't seen really evidence of higher returns consistently after all the fees and costs. And one thing that, I actually recently came across an academic paper that talks about, really calculating the fees that hedge funds are charging and versus the net returns that investors are getting. And it turns out, probably not surprisingly, the fees are really, really high. So it turns out that you can be rich when it comes to hedge fund, but you just have to run one. But if you're an investor, you're getting returns that are quite abysmal. And then the other thing, I guess, it also really comes to the power of the market. So if I think about all the analysts are out there basically doing all the trading, they are embedding their information into market prices. So in some sense, if we are using the collective wisdom that's embedded in market prices, all of these analysts are working for us. They're just not on our payroll. So as a result, for us, our value add really comes from doing those systematic research, finding systematic drivers of expected returns, and then we can implement in a very scalable and cost-effective manner. So that really allows us to charge low fees. And also because we are a pretty big asset manager, so we've got also the economies of scale, and even as retail investors, you get the institutional pricing. So I feel all of that. I hope it's something that you are glad to hear, because in the end, you eat net returns, so you want more that's in the form of returns, not in the form of fees.
Hedge fund. Dimensional is probably the exact opposite of a hedge fund, the most unhedged fund. I think one thing that hedge funds always promise is that they promise that, this alpha, that they are faster, better, and smarter and all that. But the funny thing is that I think maybe people think Dimension is hedge fund because you got so many brains and PhDs like yourselves and, Nobel Prize winners and all that. And the funny thing is that Dimension has all these brains and believes that it cannot beat the markets, which is quite different from a lot of claims of the hedge fund. This pursuit of what we call alpha, right? Alpha in the markets, alpha being excess returns over the market, is very elusive. I think that there are a few different types of alpha there. The one is the traditional alpha, the smarter, better, faster than other people alpha, and that's what hedge funds claim. But actually, in fact, we see traditional funds don't manage to do it. A lot of people, I think you have shown that. But a lot of what hedge funds thought they had returned better, and that was in the pre-global financial crisis, actually financial services alpha. Financial services alpha is when you overcome rigidities, you overcome costs. For example, lending, leverage, securities lending, being able to fractionalize, being able to get trading lines. And Dimensional does some of that as well because of their size, the economies of scale. MoneyOwl does some of that when we allow you to access at very low quantums. But a lot of what hedge funds were doing were actually based on leverage. They were able to get a lot of this, and leverage is a very major characteristics of most hedge funds. So they go long and they go short. And without leverage, after the global financial crisis, you actually saw a lot of hedge funds really underperform the 60-40. Yeah, so I think that's the, we need to know when people have the hubris to claim something, what is actually underlying those returns and how sustainable are those returns. I do not know what is the rate of hedge funds closing, but I suspect it's quite high. Yeah.
And then the problem is, there's not enough regulations to actually to give us that transparency into the returns for us to actually assess their real performance.
Yeah. And the other thing I would add, I mean, I don't work in a hedge fund, but as a consumer, what I found useful is to read the websites of the hedge funds or the fund manager or whoever you're looking at, and looking beyond the marketed information to really understand what underpins their strategy and how has that execution looked like from different time periods. So instead of just looking at what they present to you, they may say the last 10 years we've been very good, very positive. But if you extrapolate that out to 10, 15, 20, or like what you said, 40 years even, how does that look?
Yeah, and I guess I really want to kind of follow up on that, is that oftentimes there's a black box, right? When returns are great, everybody is happy, and then when the returns are bad, then you don't really know, what you should expect going forward. That's why for our strategies, we emphasize so much on that transparency. We like doing events like this to go into the details of how we actually construct our portfolios and how we get those higher excess returns, so that you know what you're getting into, and you can stick with the strategies even during challenging times, because you know where the performance come from and why we have the confidence that the higher outperformance and the track record I showed you guys that we're really proud of, why we have confidence that that track record can persist into the future.
Okay, next one. This is a question on WiseSaver. Some other cash management products are in the negatives right now. Why? And is there such a chance of this happening to WiseSaver if I put my money in as well? I think there's one for Ting.
Okay, where does one start with this? Cash management accounts is probably a misnomer. And it's been very popular among especially digital advisors, robo-advisors, to call some of their portfolios cash management portfolios. But I would say this to clients, please look at the underlying funds that make up this cash management portfolio. If the underlying fund does not have the word cash in it, it's highly unlikely that it is actually a cash fund. Most of the funds that underlie so-called cash management accounts are actually bond funds. Bond funds, short-term bond funds, high-quality bond funds, or short-duration bond funds, but nonetheless, bond funds. This means it comes with price risk, and it also comes with credit risk. And that's why you are seeing that there is a negative return because of interest rates going up. The price of bonds have fallen. And that is what you're seeing, and people are getting a shock. And then there are clients coming to me and saying that, what can I do? I said, well, caveat emptor, did you see what was there? Now, in the MAS Code of Conduct on Collective Investment Schemes, which means unit trust, it is very clear that the name of a fund cannot be misleading. And in particular, these funds that are allowed to use cash, they must have at least 10% of the NAV and the asset value maturing every day and 20% maturing every week. That is why in a rising tide, WiseSaver is able to go up. Now, WiseSaver has never had a single day of negative NAV returns because the underlying are fixed deposits, and they have some allocation to T-bills. This fund actually started more as Temasek's own treasury management. So they take these and then they place the deposits for you, because these are huge amounts of money. They place with Singapore registered banks, not just our retail banks, but other registered banks, the MAS regulated as well. And so because of that, they earn the interest and then they would transform it into unit trust. Now, if this bank goes down, then of course then you will have negative returns. But otherwise, because there is no price risk to fixed deposits, the yield minus the gross yield minus the expenses are very, very close to your NAV. So that is roughly the situation, and why it is very different, right? So I can never say never, because banks are there, and of course you don't get the deposit insurance that compared to you putting it straight in. But what you do get is the liquidity, and you possibly get that maturing, no lock in, and also when in a rising tide it goes up as well. So please look at what these underlying funds are. There are some funds that are very creative actually. There's one fund that calls itself some liquidity fund, and it's actually a bond fund, but they just got some reprieve from auditors not to have to mark to market, but it's actually a bond fund. So please look at what you're actually buying. It's just that there's no MAS regulation on how you can name model portfolios. That's probably why these are known as cash management accounts. Cash is cash, bonds are bonds, so that is, just be careful about that.
So to summarize it, if you're the one who asked this question, or if you own a cash management product which you bought previously but is in the negative right now, look at the underlying one. And if the marketed fund that you invested in says cash, but the underlying one doesn't say cash, then that's where the discrepancy could lie. And to pull it back to the second question, there's no chance of that happening in Wise Saver, right?
No, cannot say everything no chance. Even
Little
Singapore
chance.
government might also go down, right? So it's like saying that CPF has no risk. It's very, very low. It's basically to do with your if you understand fixed deposits, there's no price to fixed deposits, right? So there are a bunch of T-bills, but they're very small. So of course it's possible that T-bills, the prices go down. You could mark negative, but it's never happened before. It happens if there's something wrong with the financial institution in which the fixed deposits are placed.
Okay, so I'm going to pull up this, which is a related question. What is the difference between Wise Saver versus putting cash in Singapore Bank's fixed deposit, given that the interest rate is similar? Okay, I'm going to start off first. As a consumer, I did study this and I had this question as well. My answer or my conclusion to it was that I didn't want the lockup period. That was the most important to me, because putting in on a fixed deposit, which the 6-month rates, if you all realize, are not very attractive, right? The more attractive ones start to come in at the 18 months to 3 years rate. And I was just very uncomfortable with locking that in, because I don't know if the Fed would raise their interest rates and hence these rates would go up in the future. And I had readers who told me, I regret locking myself into a 2-point-something short-term endowment a few months ago, because that's for 3 years, and now like elsewhere it's 3-point-something. I wish I could. Can I take out my money there and move it over the 3-point-something? And the answer is no. So to me as a consumer, that is the biggest difference. But yeah, Chuin Ting, maybe you would be better placed to answer this as well.
The fixed deposit, firstly on the risk side, if the bank goes down, fixed deposits are guaranteed up to 75% per consumer per bank. Wise Saver units are not, because they are actually units of a fund that invests in fixed deposits. So we don't call ourselves deposits. We're not allowed to call ourselves deposits. So that is one. So you need to, if you are really, really risk averse and you want that, then of course go for fixed deposits. But it's actually the structure, right? Because we invest in overlapping fixed deposits. They're layering, because 10% matures every day, 20% mature every month. So what happens is that you can probably get better rates without the lock-in. And that's why the use of this unit trust structure actually transforms fixed deposit into floating deposit rates. And that's why the Wise Saver average rates have been going up. But I do feel that maybe we are concentrating too much again on these things. I don't really like it when people invest in my Wise Saver, because I don't earn any advisory fee. Yeah. But anyway, but it's there. It's actually for your emergency fund, and you can buy as many units as you want. Right? That is the rate itself or whatever is not guaranteed, but the level of risk, and it's liquid, and the T+2 is in your bank account.
Okay, I'm just putting out these because I thought it would be nice to let the MoneyOwl team see it before we end. But yeah, can I just end off with one last question? Sorry, they're chasing me, but I wanted to put the spotlight back to something that's more generic, and I think this question got the most number of votes, so we have to answer it, right? Okay, and let's see. So the question is, for all the speakers here, do you foresee recession occurring in the next 6 months? I know we all don't have a crystal ball, but I think they're asking this because they're interested on your insights and perspective. Maybe Dr. Wei, you want to go first?
Yeah, I think some people are even saying, are we already in a recession? So I already said in my talk, nobody has a crystal ball. I can have my guesses, but it almost doesn't matter. So I don't know, but for investment purposes, you don't really need to know. It's not because the microeconomy doesn't impact market. It absolutely does. But the potential impact of a recession or the probability of it's happening in the next 3 months, 6 months, and the potential impact on the real economy and the company cash flows are already embedded in today's market prices. So, you see, for example, a downturn in the market, for example, is because due to, let's say, potential slowing down of the economy. And the market is not waiting for, say, the actual profits of the companies to become lower and then to be reflected in today's market prices. So those forward-looking expectations are already built in. And so even knowing when recession will happen or whether or not we are already in a recession will not help you make better investment decisions. So, and then that's why when you look into the historical data and look at, for example, stock returns in the, let's say 1 year or 24 months after an onset of a recession, you actually see the majority of cases of positive returns. So again, going back to the idea that, well, of course you should care about what's going on in the economy to be an informed citizen, but don't use that to inform your own portfolio decisions.
Chun Ting?
She's PhD. She doesn't know. I'm not going to. Yeah.
Maybe one thing I will also say is I really like one quote from Jerome Powell because we were talking about inflation, and one thing he said, he's central banker, saying that we now know a lot more about how little we know about inflation. I think it's the same thing for a lot of the macroeconomic things.
I suspect Jerome Powell doesn't know. He himself doesn't know whether there'll be a recession in the US, and recession, there's a technical definition and all that. But I think that there is a good chance that we need to look at our finances. It's not going to be that comfortable, right? And I think we are already all feeling it. So if you want to say that whether there's a heightened risk of recession now compared to how we were feeling, say, a year ago, the answer is probably yes. But what does it mean for us? Actually, what it means is that, well, we are having higher prices, we're having greater job uncertainty. So use that so-called fear or uncertainty not to change your investment strategy in the long term, but to address your financial planning needs in the short term. Right? So you have to continue to pull your weight at work, like you say. When as a boss, I'll tell you that I'm very happy when people come and demand more pay if they are showing the value, right? So it's about productivity, and it's about being the best at what you do, and then restructure your expenses, please, because that's the only real way that you can respond, be it recession or whatever. That is how you be resilient through recession. Build your emergency fund. So again, I don't know. I think that it is not so comfortable for us because of inflation. If there's job uncertainty, you definitely need to then prepare yourself. How do you prepare yourself? Well, financial health, right? Financial health, and look after cash. Right? So have an emergency fund. We talked about CPF just now, and I think I briefly mentioned that we don't recommend everyone to invest CPF. My CFO hates it when I say this because we actually have a CPF investing service. But CPF can also be your buffer for paying mortgages when mortgage rates increase, or when cash becomes precious. Right? So look after your cash, especially if you think you're at risk, right? But use macro data and information to make short-term financial planning adjustments and not change your long-term investment strategy.
I'll also add on, actually Chun Ting took most of the words out of my mouth. For me, I don't know if recession is going to happen in the next 6 months, and I'm trying not to care. Not that I don't care. But I think what really strikes me when I think about it in terms of my household is how can I protect my job? How can I make sure that if a recession does come and people do get laid off, I'm not one of them? And if there is a possibility that I might be one of them, then what can I do in terms of income from other resources or to fall back on emergency funds? And just to share with you guys, I have this conversation with my boss as well. I didn't ask for a pay raise because I didn't feel like it was a good time because, you know, we're all going into a recession and the company is starting to talk about costs. So I didn't raise that. But what I did ask was this one question. Boss, can you tell me very honestly, is there a chance that there are people in our team who might be laid off in the next 6 months? And my boss answered me, I don't think that's going to happen. And I'm going to prevent it at least on my watch. And if anything, I'll be one of the first to go instead of you guys. And hearing that from my boss was very reassuring, but it still wasn't 100% reassuring. So I still look into, do we need to build up more emergency savings? Do we have enough insurance? And yeah, I thought that might be something that you guys want to think about or even ask your boss that if you have that relationship.